You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIW Tweets.
Hello, welcome to The Investor Way with me, Sam Ball. It's the 31st of December 2022, and I'm joined for the final time this year by my co-host John McEwen. In this week's episode, we will be updating our £1 million fantasy portfolio for the third year now. For anyone who hasn't listened to the earlier ones or wants to recap them, I have reposted them. So the previous two episodes should be when we originally constructed it and when we reviewed it last year now. So if you do want to go back and listen to that, you can. Otherwise, I'm just going to go through it on the assumption you sort of know what we're talking about. So John, if you're ready, I don't know if we want to just dive in that case.
Yeah, I think so, Sam. Do you want to take it from the top? So
yeah,
we'll go through, as we did last year, we'll go through the allocation that we've got in terms of different assets and then the stock specifically.
Yeah.
Do you want to kick us off with Bitcoin?
Yeah, so Bitcoin. So we wanted an allocation to commodities, and I think what we did was we did 17 and we wanted 20% allocation to commodities. We did 17.5% in a commodities index and the other 2.5% in Bitcoin. Bitcoin was flying high last year. However, it's not had the best of years. So it's now down 29.41%. And that's it was up 78% this time a year ago, but it's now down overall 29.41. So it's had quite a bad year. So that weighting is now at 1.69%, and that's from a 2.5% original weighting. The commodities index, however, has done quite a bit better. So the Bloomberg Commodities Index, which I'll get up actually, because I think it'd be quite useful to go through what's in it. Yeah, it's the Invesco Bloomberg Commodities Index that we put 17.5% in that. So that was 175,000. That's now worth 290,652. So that total performance is 66.1%. And that now has a weighting of 27.75% because that's done so well. And also, as we will get to very shortly, everything else has done crap. So let's see what's in this. Top 10 experts. So so this is stuff like crude, oil and gas futures, aluminium, nickel, zinc. So it's just stuff like that, really. I think it's got like furs and stuff as well. Here we go. 24 commodities are eligible for inclusion, covering 6 commodity groups: energy, grains, industrial metals, precious metals, softs, and livestock. They're weighted by 2/3 liquidity and 1/3 by global production. So yeah, I think I'll sort of almost skim over the commodities index because I do want to talk about it a bit more below, but when we do come to it later on, I would propose rebalancing it now because we are including the Bitcoin 29.44% commodities up from an original 20%. So that's the first 20% of the portfolio. Do you have any comments on any of those, John?
No, I would tend to agree with you. We've discussed it on several occasions, the allocation and the reason for the allocation to commodities, but we've cited Andrew Craig's How to Own the World a few times, and he suggests an allocation of just 10% of the one's total portfolio. So we're well over that, but we'll come on to that.
Yeah, and it has worked out quite well for us. We should have going so far over because we did it just before we weren't having much inflation at the time we did it. Although in fairness, I think it's fair to say when we did do it, we were both concerned about inflation. But I probably wouldn't expect it to have done as well as it has. So
no.
Next, so we had 20% commodities. We then did 40% just in index funds, and that was just split. Yeah, that was split 8% into 5 different index funds. The first one was Vanguard FTSE Developed Asia Pacific Fund. So that covers countries like Australia and New Zealand and like Singapore and stuff like that. So Asia Pacific, but I think it excludes China specifically on the basis that's in emerging markets. So we put 80 grand into that. That's now worth 76 grand. So it is down slightly. However, we have been getting about 3.5-4 grand of dividends a year. So excluding dividends, we are up a little bit. But that's basically treading water. I've got no issues with that. Very happy with the yield. It's currently at 4.86%. The current allocation is 7.26% now. I wouldn't really propose doing anything with that, if you're in agreement, John.
Yeah, no, I would leave the indexes as they are.
Perfect. In that case, I'll just run through the other four. So the next one is a developed Europe excluding UK on the basis that 20% of the portfolio is invested in UK listed stocks anyway. So this is the rest of Europe, and we put 80 grand into that. That's now sitting at 87 grand. However, that mainly it's not performed that dissimilar to the Asia Pacific. It's just that this is an accumulating fund and the other one was paying out as a dividend. And that now stands at an 8.35% weighting. We then had an iShares Core S&P 500 index fund. So that's just tracking the S&P 500. We had 8% in that. But in addition, we do have probably about 20% of the portfolio in US listed stocks. However, I haven't gone back and listened to the original episodes, although I did re-release them. My guess would be that we just thought the US market was so big that it was probably too good not to include. I suspect it was you that pushed for that to be in there, John. So I will give you the credit because it seems like the sort of thing I would have left out. But we put 80 grand in there. That's now worth 94. So that's up 18.6%. And that's now worth 9% of the portfolio. We then had 80 grand in a Japan fund. That is down slightly to 78 grand. And that's now 7.5%. We also had an emerging markets fund, which is down slightly from 80 grand to 74 grand. And that's now 7% of the portfolio. So that's now 60% of the portfolio covered based on what we originally put in. So we've done the 20% commodities and we did 40% split between 5 different index funds, the idea of which was to cover the entire globe. So we now move on to the individual stocks. I think we tried to split the remaining 40% between 20% UK, 20% US, and then we diverged from that a little bit last year just because we felt like a lot of the best opportunities were in the UK. So it's probably about 50-50. In fact, it'll be a lot less now because the US stocks have performed a lot more poorly. But what we did was we put a 2% allocation in everything, so 20 grand, except for Disney, which we'll get to later, that was a double allocation. And except for Airtel Africa last year, where we put 28 in because we had a little bit of money left over from the dividends. So I'll just run through these line by line, and I will cover any that I propose getting rid of. So Associated British Foods, we've covered it multiple times on the show, a favourite of the show. It's best known as the owner of Primark, but it does have a lot of other stuff going on. It's got a big sugar business. It's got quite a few food brands like Kingsmill Bread and Patak's, the curry powder and paste and jars. So we put 20 grand into that. That's actually down. That's about 16 grand now. However, we did get about £400 of dividends from it. So that now sits at a 1.5% weighting. That was actually a new addition last year. I'm pretty happy with that. It's not down 18%. It's not ideal. I probably wouldn't bother adding to it, but I'm quite happy holding that one if you're in agreement, John.
I'd agree with you there. I still like it.
Yeah. So in that case, Airtel Africa next. That was a new addition last year. Unfortunately, we did find it in about May time, and it was a lot cheaper, but we only update this once a year to reflect our long-term strategy. However, it did mean that it'd risen quite a bit since then. So we actually got in it at £1.27 a share, which for most of the year, it was comfortably beating. However, it has dropped recently and it's now £1.13. So our 28,700 is now worth 25.5 grand. However, it does have a dividend yield of 3.5% and it has paid us about £1,000 of dividends. But in total, we're down about 8.5%, and that's now a 2.5% weighting. I'm actually a bit disappointed by this one because it has been one of our best picks on the show, but we've just been unfortunate with the timing. However, I do like it. It's one that I would consider adding to. However, I haven't proposed adding to it just because I think it's a decent weighting. It's still at a decent price. But I, as anyone will know who's listened to us cover it before during the year, we do like it a lot. But at a 2.5% weighting, I'm fairly happy with it as it is. I don't know what your thoughts are, John.
I like it, and I would actually propose adding a little bit more to it. I think there's it's got a lot of really strong fundamentals. It's not expensive, and conviction is high with it. So I'd put that on the table.
Right, I'll add that to the list to discuss later on. I should add as well that prior to the show as part of the prep, me and John have gone through and come up with what we would propose adding and taking away from. We haven't discussed this in advance, so no decisions have been made, and we we don't actually know what each other are going to push for that much. So this is going to be authentic. So if we do get into a disagreement and there's no further episodes, you know why. So next one, unfortunately, is another new addition from last year, and it's Boohoo. Boohoo, we added to it last year at about £1.20 because we thought it was pretty cheap. The good news is it's now even cheaper. It's about 36p a share. So that's down just under 70%. So looks like we put in 20,000 and we now have 6,000. I'm disappointed with the performance. I would back it to do well at this level for the reasons we've been over in recent episodes. But there's a lot of risks with this. I think we've already put a decent amount of money in. I wouldn't want to get rid of this, but I wouldn't want to add to this one. I think I'm quite happy with our initial 20,000 and just see how that rides.
Yeah, I do still believe in it, but I would tend to agree with you. I think we'll just leave that and that what is now quite a small investment, but left in it and see how it goes.
Yeah, so that's one of the good things with not adding to losers is this is now only 0.58% of the portfolio.
Yeah.
So most of the damage has already been done. So if this does carry on going down, it's not really going to affect us. Although hopefully it will come back because we do like it. Next one is Games Workshop. So again, at the time we bought that was quite expensive. It's had a bit of a roller coaster this year and it's done very well in recent months. They've just announced a deal with Amazon to produce content, which was something we were very keen on. We thought there was a lot they could do with the IP. We put 20,000 in. We've had a couple of percent dividends. However, in total, we are down about 10% because it went down a lot and now it's mostly recovered. I'm very happy with this one. I wouldn't be against adding to it, but I just think it's so similar to the original price and it's still a fairly decent allocation at 1.7%. Unless it dropped, I don't really see the need to. If we come back in a year and it's down, I possibly would, or all things being equal with the business, because I do really, really like it, but I'm pretty happy with the current allocation. What about you, John?
I like it. In fact, I like it a lot. And particularly since we're seeing what we'd thought, we're seeing some of that potential with the IP being realised, or hopefully being realised in the Amazon deal. It would be a maybe for me in terms of topping up on it. We'll see what else we've got when we come to the end of the show, because we're not flushed with funds to reinvest. So
no, we are not.
See. And we'll see about the potential sales as well. So maybe.
Right, I'll put that in the discuss pile. So next one, Unilever, a company we all know and love on the show. We put 20,000 in that originally. It's pretty flat. It's down slightly, but we've had 3.5% dividends from it. I'm pretty happy with it overall. I think it could have been worse, considering in the 2 years that we've owned it now, I don't think management have covered themselves in glory. We could have very easily ended up with some Haleon in there as well, but we didn't. But yeah, I'm quite happy holding it. I certainly wouldn't get rid of it because I think there's some very high quality brands and I wouldn't want to bet against them. But I wouldn't propose adding to it at the minute. What about you, John?
Yeah, very happy holding it. Just leave it alone.
Yeah, next one, Taylor Wimpey. Housing stocks have not done very well at all. It looks like we got it at a fairly reasonable price because we put 20 grand in and it's only down a third. I do quite like Taylor Wimpey. I haven't proposed doing anything to it. I'm quite happy just banking that dividend. So we've had £1,000 of dividends from it. It's sat at 8.5% yield now. I'd be quite happy to leave it be, especially given that we've also got Rightmove as well. And I know Rightmove's a slightly different play on the housing market, but I think we've got enough exposure.
Yeah, I would tend to agree with you. They do look that there does look like there's quite a lot of value in both Taylor Wimpey and still in Rightmove, although it's more expensive stock. And if we were to be contrarian, that might be one that we'd top up on. But we'll see. We'll come back.
I can add it to the list.
We can discuss it.
Okay.
There could be better. I've got a few thoughts, so we've got potentially some better options. But we'll
if we both think that, there's probably no point discussing it. Because I'd also say there's probably better options. Fine. But I do agree. I think if we were sat here and it was down 70% like Boohoo rather than a third, I'd probably be much more looking at topping it up. But it's not really Do you know what I mean? We put a decent amount in anyway, and most of it's still there, so I'd probably just leave it. So we spoiled this one slightly, but Rightmove next. We put 20 grand into that. That's now worth 16. We're getting a 1.5% dividend as well. Overall, that's down about 20%, and that's now a 1.5% weighting. By the sounds of it, we're both in agreement to just leave that one alone. Next, we got Money Supermarket. I was surprised I'd managed to get this one in there, actually, because I feel like it's something you would have possibly tried to talk me out of, because 2 years ago, I don't think you liked it as much as you have.
No, it has grown. I've understood it better.
Yeah, but unfortunately...
Not enough to buy it, but...
Unfortunately, as you've understood it better, the price has dropped. So if you talked me out of it, we probably wouldn't have had it in there. But that will definitely have been my suggestion. But we put 20 grand in. It's now worth 15. We're getting a grand of dividends a year. That's a decent yield. Down 20% overall, but I'm pretty happy with it. I like the business. I think the last few times we've covered it, we've thought it was pretty cheap.
Yeah, I would leave that alone too.
Yep, agreed. Next one, HomeServe. So we put that in a couple of... I actually forgot this was in there. I was updating it today. But we put 20 grand in. It's now worth 22.5. We've got some dividends. We've got about 0.5%, but they are now under offer. So there will be a deal. I don't know when it goes through, but at some point in the near future, that will be acquired for £12 a share. It's now trading at £11.97 a share. And if we leave it, we're just going to get the cash anyway and not be able to reinvest it for a year. So I would propose selling that now, because it's so close to what we're going to get in any case that we may as well invest the cash.
Yeah, that's fine. I'd go with that.
Next up, we've got Hargreaves Lansdown. This will definitely be one of mine, because I know John doesn't like it. So we put 20 grand in. It's now worth 11. We're getting a 4.5% yield. It's down 40%. For reasons we've explained recently, I do like it. They've started launching their own funds now. They've got, the interest rates are going up, and they're going to be making a lot of money on the cash. They've moved into the cash ISA market. I think there's a lot that could go right for this business. That being said, I accept it's a competitive market. I appreciate John's concerns about it being commoditized. However, for 11 grand, down 40%, I would propose just leaving it alone.
Yeah, I would tend to agree with you on just leaving it, but it wasn't my favourite.
Nope, I'm sure I didn't go back and listen to the first one, but I'm sure you would have made that very clear at the time. However, we do have next one of your favourites, Diageo.
Diageo, yeah.
So we put 20 grand into this one. It's now worth 25. We're getting a 2% dividend a year. I would like to add to this if it wasn't so expensive, but it's what is it, like a PE of 30 at the minute, or 25?
Yeah.
So it's a company I'd actually quite like to see come down for next year, really. I really like this business. They've got some fantastic brands. I mean, we looked at Brown-Forman the other week, and the brands just aren't as good. Very happy with how it's performing, but I wouldn't add to it at the current valuation.
I know. It is difficult. I'm not proposing adding to it. Obviously, very happy holding it.
Yeah.
It wasn't cheap last year either. I would make that point. And some of these really high-quality businesses are virtually never cheap, and you do have to swallow
it was quite a bit cheaper when we bought it, because we are up 28%.
Yeah. No, we are. But it wasn't. I think you would have made a similar point. While it might not have been as expensive, that it was, not a cheap stock to buy.
Oh, it wasn't. Yeah, at no point. I mean, I don't think we've seen it under a PE of 20 in the time we've been covering the show. Next one, Alibaba. So we bought this last year. We put 20 grand in. It's worth nearly 16 now, down 21%. I know it's not great because we only bought it a year ago. I'd propose getting rid of it. I like the business. We've covered it a few times on the show, and I think there is some value there. But I would just say opportunity cost with that one. I think there's a lot of stuff that I would like to add. And I just think it's not a business we follow particularly closely. And when it originally went in and we were first covering it, a lot of the tech stocks, for example, were a lot more expensive. And they've come down now. That the difference between sort of the Alibaba and, say, for example, like something I've proposed later on, PayPal, there's not that much of a difference in the earnings now, the PE. I know they're different businesses, but when we first covered it, the US tech stocks were just so much higher. I think there was probably still some of that a year ago. So I just think I'd be happy holding it, but I think it's only down 20%. I know it needs to go up 25% just to get back to where we were, but I think there's stocks where we could do that better than Alibaba. What do you think?
I would be more inclined to stick with it. I don't think it has been given the benefit of the doubt, and I don't think the fundamentals of it either have changed. I know you're making the argument with opportunity cost. We'll come back. I think we'll come back to it when we've got some of your proposals.
And you mentioned this off air, but we did give opportunity cost as a reason for selling AstraZeneca last year, which
we
you reminded
did,
me of.
and we sold AstraZeneca at about £84 a share. It's now about 113, I think. So it's about nearly a third. It's gone up nearly a third since we sold it, but that was sold for the reason of opportunity cost. But anyway, sometimes we are better just sticking with our original convictions. Although Astra, when it went in 2020, wasn't the strongest, but anyway,
I do like Alibaba. I think when we've covered it on the show, we have thought it looks cheap. So like that was a sort of, for me, it was because we didn't have much cash as well. So it's like, well, if we want to buy something, the cash has to come from somewhere. But if you want to keep it, I am quite happy to. It's not my favourite stock in there, but I'm conscious there's quite a few in that you don't like. So if you want to keep it, I'm quite happy to just say that's it. We'll just keep Alibaba in there.
Yeah. Okay.
I don't want another AstraZeneca on my hands.
I'd probably leave it.
Okay. Right. Next one, Fiverr. We've covered this a few times on the show. I think it's in an industry that's got a lot of potential. It'd come down quite a lot last year. It was down sort of 60, 70% when we bought it. It has continued to go down, and it has gone down a lot. So we bought it about $130 a share or something like that. It's now at about 30. It's down 74%. I really like this business. If we had more cash, I'd potentially argue for adding to it. But I'm also conscious it's a very high-risk stock. And although it's come down a lot, we did still buy it at an expensive valuation. It was just cheaper than it had been. On balance, I'd say, I know we've only got $5,000 in, so in a £1 million portfolio, this is now tiny. But I sort of feel like it needs to earn its place. And it hasn't done that so far. So I don't like it well enough that I would throw bad money after good. So I would propose just leaving it alone.
Yeah, I just leave it.
Okay. Next, we've got Facebook, or Meta, as it now trades under. So we put 20,000 into this 2 years ago. It was up quite a bit last year. I know it's not at the best of years, unfortunately. Yeah, last year it was up 25%, 26%, and now overall we're down 50%. So that's had a horrible year. I think it's down about 75% or something, or 70% or something like that. I do like it, and it is cheap, but I do have concerns about the direction of the company and the fact that Zuckerberg has complete control. I'm not entirely sure on the metaverse, and I think they should just focus on the ads, really, because for me, this business could be trading at the same multiple as Google. I think it's that good. I think it's that important. I don't think the Facebook app's going away. They've still got Instagram and all these other platforms, but I think a 10 grand position, I'm pretty happy with that. I probably wouldn't propose adding to it. What about you?
No, again, I would leave it and, not make any changes there.
Yeah. Next, we've got Etsy. So this is one of my favourites, actually. I do like this one. What was it doing last year? So last year, it was up slightly. It was up 18%. It's not at the best of years, and it's now down 30% overall. I really like the business. I wouldn't be against adding to it, but I'm conscious that you don't like these types of stocks. And we've already, it's still 14 grand we've got in there. So I think we've still got enough that if it does well, we'll do well. I don't think it's had a particularly terrible year. The valuation's come down a bit, but I think the valuation's pretty reasonable. I liked the valuation last year. It's one of my biggest holdings. At the minute, my top 3 holdings personally sort of fluctuates depending on the share price between Etsy, Airtel Africa, and Games Workshop. But I do really, really like this one, but I just sort of think 14 grand's enough that we can just leave it. But I would caveat the performance with this. This is going to be a very volatile stock anyway, so this could easily be up 20 or 30% next year overall, and then down again. It is just one of those stocks. So I'd propose leaving that alone.
Yeah, no, I would leave that too.
Pinterest, put 20 grand into that. That's now worth 7.5. It's down 60%. I think this is just more of a valuation than much else. Monthly active users are declining. However, they might have stopped the decline now, but they had this massive surge in COVID. But it's the monetization of the users that's still in its infancy. I think if that comes good, which I think it will, I think we'll still could do very well out of this. But it kind of goes back to what I was saying with Fiverr. This is down 60%. It's a 7.5 grand position. I think it's that small. There's no point selling it, but I wouldn't add to it because I think it's got to earn its place in the portfolio, and it just hasn't done that yet. And it's not a business I like enough that I would buy it when it's down 60%. I'd probably just wait and see what happens with it. What about you, John?
Again, I would leave well alone.
Yeah. Kraft Heinz, this is one you like, John. Put 20 grand in. It's now worth 26, and we're getting a 4% dividend a year. So this is now 2.5% weighting. I think I might have argued to get rid of this last year. It seems like something I would have done. What was it at last year? So it's at 26 now. Last year it was at 21, so it has had a cracking year. I don't know what the valuation of Kraft Heinz is like. I sort of remember when we last covered it in the show, I thought it was all right. I thought it was in line with sort of all the other ones. There didn't seem to be much of an American premium. It's got some fantastic brands. I know there's definitely some psychological bias in here because my opinion has changed as it's gone up in the fantasy portfolio. But I feel like this has earned its place now. I wouldn't really propose getting rid of it. I'm quite happy having it in there now. What are your thoughts?
Yeah, and it's solid earnings. It's like Unilever, and it does give some. It does generate a lot of cash. I like it. I think the brands are fantastic, and it's in my own portfolio. It's my single largest holding now that I've sold Shell. So I have a strong conviction with it, and I'd happily keep it. And it's got a decent dividend too.
This has grown on me as we've covered it over the years. It has grown on me, actually. I think that it's a bit like Unilever, really, where it's like there is clearly a very good business in there. Yeah. So next up we have Berkshire Hathaway. We put 20 grand into that. It was the B shares, I must add. Couldn't afford an A. And then that's now worth 30.5 grand. So that's up 52%. Thank you, Mr. Buffett. And that's now at 2.91%. I really like it. It's probably still pretty cheap. I've not looked at it in a while. I wouldn't be against selling it to raise cash, though, if we wanted to rebalance. But we had this discussion last year, and you argued it was too good to keep, and I think that was a good decision. So I think last year it was at 26.5 grand. I proposed getting rid of it, and you argued it was too good to get rid of, and it's gone up another sort of 10% or so and comfortably beat the market. So I'm pretty easy on this one.
Yeah, I would keep it. I think you look at the quality and arguably the world's best investor at the helm. So I would leave that alone as well.
Don't think we could do better ourselves with it.
Well, you wonder whether it's cheating.
Not based on this performance.
Yes, certainly not. We'll come on to it. Yeah. I think we've just got one more to go. Walt Disney. Yeah. Well, probably the favourite of the show.
I think that's fair.
Hasn't had the best year. I mean, it's more the valuation than anything else, as we've seen with a lot of US stocks, which have come under pressure. It's down 44%. It had double allocation. I still really like it. I still have it in my own portfolio. In fact, I've topped up on it over the last year, and I have no issues with holding it or even adding to it.
I have also proposed adding to it potentially, which we will get to shortly. But yeah, definitely don't want to sell it. I'd see where it was at last year. So we put 40 grand in. It wasn't actually, it was down 12% last year. So it was worth 35 grand. So it's only in the last year it's really taken a hammering, but I still really like it. In terms of the dividends, we've had 10.5 grand of dividends that have actually been paid to us, or would have been paid to us if this was real. We have actually had more than that, but some of the index funds are accumulating funds, so they're not included because they're just reflected in the share price. So of our original £1 million, at the end of last year, we did have 1.12 million. We are now down to 1.047 million. So we have had a decline of 6.48% in the last 12 months. However, drumroll, our benchmark was the MSCI World Index Accumulating. That is down 7.02%. So I don't want to celebrate a loss, but we did beat the market in the last 12 months by 0.54%, which I think, given the climate and the number of individual stocks that have performed poorly in there, I think we'd have to be very happy with. Overall, so this is the past 2 years now since we originally picked the stocks, we're up 4.73%, and that compares to 9.74% for the All World Index Accumulating. So overall versus their benchmark, we're down 5%, but we did pull it back a bit last year, and we are still in positive performance territory. I don't want to start like giving ourselves victory laps when we're down, when we've had a down year. and we're down to the market over the 2 years. But I think to keep the performance positive and to have just picked the market in the last 12 months, I am pretty pleased with. I did think it was going to be a lot worse because, like I say, we don't update these during the year. We just go in after a year and just see how we've done. And I thought it would be a bit of a bloodbath, really. What has saved us, as I said at the start, is that commodities allocation. We put 17.5% in, and that's now 27.75%. So that has made up for a lot of very poor stock picks. John, do you have any comments or thoughts on that?
Yeah, it says a lot for allocation and the weighting of your portfolio. And yeah, you could argue that we were over allocated towards commodities, but that they've had a very good year and that has saved us. I suppose the next question is, do we make any changes? And if we do, can they help us beat the market next year?
So I think home serve we need to get rid of just because otherwise we're just going to know the cash and it's just going to sit there for a year or however long. So I think home serve, that's probably in no-brainer territory for selling because if the most we can make by keeping it is 3p a share. So home serve's gone. There's quite a lot of businesses. So so the only other thing is really, assuming we are happy, we don't want to sell any of the stocks we discussed. I think the conversation about where any funds come from for new stocks, it would have to be rebalancing. No, I think almost 30% commodities is quite high. And I think we probably should rebalance that slightly. I propose rebalancing by 4%, so getting rid of 40 grand of commodities. However, that was whilst I was also proposing selling Alibaba. So I don't know if that would need adjusting or what you've proposed. I guess it depends what we agree we want to buy as well. So on my list of companies I would consider or would want to discuss adding to the portfolio or increasing the allocation, it would be Supreme, PayPal, UK Domino's, Gamma Communications, Airtel Africa, that's one of yours, Games Workshop, that's one of yours, and Disney. Do you have any others to add to that list for discussion?
I don't really. I think if I'd gone near two, it would probably have been Taylor Wimpey and Rightmove. But on balance, I would say probably just leaving the allocation that we have to those. What I would wonder is how much do we cut the Bloomberg Commodities Index by in terms of weighting? Whether we cut it, because in my own portfolio, it's more like 10%, and it is there as a hedge against inflation. I appreciate we've had a very good year. But do we cut it to 10 or 15%, which would free up more cash?
I think, so we were doing Andrew Craig. I know it was high, but I don't think we should take it below the 20% original allocation, including the Bitcoin.
Okay. I suppose if you were to be critical of it, you'd say, well, it may be a hedge against inflation, but it's an unproductive asset class.
Yeah, I would say we've got 10% inflation right now. And as a hedge, it's worked very, very well. So I think 20% has proved to be a good strategy. And if we reallocate and it turns out that it then declines, it might get to 10% on its own. I know it's not as fun as if we just cut it all back and just time it perfectly. But I think we need to consider that, like, obviously the issues that we were concerned about when we originally did that high allocation, a lot of those issues and sort of economic issues, they are still there. I think I am still concerned about inflation. I think the commodities, I think they serve a purpose. I think just because they've served it well, I don't think it doesn't mean they won't. Because I don't want to be in a position in a year's time where actually the commodities have done another 20 or 30%. The stocks are down even more. And we're thinking, well, what did we actually cut that? I only want to cut it if it gets to an uncomfortably large level. I know I'm ranting a bit. Okay.
We can leave it. We can not cut it as aggressively.
Okay. So in that case, how much would we want to cut it by? So we've got 290 grand plus the Bitcoin. I'd probably just cut it to 200.
Yeah.
So 90,652. Right. So that gives us, along with HomeServe, 113 grand plus 10.5 grand of dividends to play with. So we have got 123 grand to play with. Should we go through sort of line by line the stocks we've suggested adding and just see whether that adds up at the end, or whether we then need to think about actually how much we're putting into each one?
Yeah. So you mentioned Supreme, Sam.
Yeah. So we covered it twice on the show now. I've bought it personally. I appreciate that you have raised ethical issues. However, I would like to say this is a fantasy portfolio, so we are just looking at what stock we think is best. And I think in terms of the actual business, it's very cheap. It's in a growth market. I think that vaping is, I do like the look of that. And then as well, they've got the minerals as well, plus the steady, like the lighting and the batteries as well, and all the other bits and bobs they do. I think the valuation is very cheap. I like the management. And I think in the grand scheme of things, I think I would only propose, I'd propose a normal allocation, so just 20 grand. But I would stress, I think we do need to put ethical issues aside because this is a fantasy portfolio.
Okay, so you would allocate 20 to Supreme.
Yeah.
PayPal.
And PayPal, we've covered that. We've only covered that once. I would caveat by saying in real life, we would want to do more digging before we actually put our own money into this. But it looked very cheap. I think it's a very good brand. It's not quite Visa or MasterCard, but it's trading at a PE of like 16. It's down about 75% or something ridiculous from the COVID high. It's down that much that we don't really need to worry about exchange rate and how poorly that's done in the last year. But I think, again, 20 grand, I think it's a very good business. I think it's a very good valuation. And I really liked it at that price. So again, I would propose a normal allocation to that.
I'd be very supportive of PayPal. I think the valuation, I mean, with a lot of those businesses, we know they're high quality, but it's always been a question of valuation and then exchange rates. But at that valuation, I think for such a good company, it would be, a definite one for me.
Okay, next one I propose is Domino's. So this is the UK Domino's. We've covered that we've covered it multiple times on the show. I do like it. I think certainly if you compare it to Greg's, I think their medium-term targets are pretty realistic. I think the valuation's good. So it's at a PE of about 14.5. Dividend yield about 3.3%. I think the avenues they're exploring for growth, I like the growth targets. I thought they were realistic. Like it's something like going from like 1,200 to 1,400 stores in the UK. They are predominantly UK. I think it's a 41% market share for the UK pizza market. That might just be pizza takeaway, but it's just absolutely dominant in takeaway pizza, really. I think it's a fantastic business. I think the US one's a fantastic business, but the valuation's just silly. But in the last year, this business is down 36%, and I think that valuation's looking pretty reasonable now. So I think it's one we've covered and liked before, so I would propose a 20 grand allocation, so about 1%.
Yeah, I don't dislike it, and the valuation is reasonable. But I do wonder about some of the other stocks that we've got in the portfolio, and particularly sort of Airtel Africa. That was one that sort of stands out for me, that we both have a very high conviction with, and it's certainly not expensive. I don't think the fundamentals have really changed. So I would wonder about that as opposed, rather than Domino's.
Okay, should we leave that and see if we've got money left at the end, or do you just not really want it?
I'm not desperate for it.
Right, I'll take that off the list then on that basis. So, my next one's Gamma Communications. It's in my own portfolio. I like the acquisition strategy. I like the valuation. I like the market. It's quite difficult to get your head around, but I think this is a very nice little company. We talked about it on my interview recently with James at Quality Compounding. But the price is pretty low now. And considering the numbers it's been putting up, I appreciate this is a difficult business to understand. And I won't go, I think if you go to the first time we covered it, we did try to sort of explain bit by bit the different parts of the business. But this is a complicated business. But it's trading at a PE of 16, 17. It's now got like over a 1% dividend yield. And if you look at the financials for the last 5 years, the growth's very impressive. And it's all financed by, they just invest in those retained earnings. So yeah, in the last 5 years, they've taken revenue from 242 to 447 million and the operating profit from 26 to 68 million. So I think for those kind of figures at a PE of 17, I think it's really, really good. So I'd propose a 20 grand allocation for that.
Okay. I would be willing to go with you on that, Sam. It's definitely not my area of expertise, but I appreciate you're very keen on it, and it's not something that I think is outrageously valued.
Okay, so if that is down in a year, obviously you will and throw me under a bus. But Okay, so we've next got Airtel Africa, which I'd proposed leaving as it was, but said I could be persuaded. So we've already got 28 grand in. That's now worth 25. What would you propose adding to it?
I'd probably top it up by 10.
Do you want to just take it to 40? So it's a double allocation, or do you want to just do
Yeah,
10?
no, we could do 40.
So that would be 15,000. So that would be only the second ever double allocation after Disney.
And we saw how well that went so far.
Absolutely. Yeah, I said I could be persuaded. I haven't actually asked you to persuade me because I could be very easily persuaded because I do like it a lot. So Airtel Africa, that can go in. I'll just get the share price. So we're getting it at £112.50. I did not think we would get the chance to buy this cheaper in a year's time when we did this last year. But this is a favourite of the show. It's not like Disney, which is the favourite of the show, but I'm very happy with that one. So, Games Workshop is next. That was actually your suggestion, despite it being, at the minute, my biggest holding. Do you want to talk about why that is and what you would propose adding to it? So just for reference, at the minute, we've got 17 grand in there.
I mean, we like it for a number of reasons, but I think the reason to add more to it is that we're seeing those, I suppose, that future, those potentials that we saw in the business coming to fruition a bit more with the latest deal with Amazon and the TV series. Is it a film, Sam?
I don't really know. I think they're just bringing the photo. I think it'll be a series.
The series or potential series that's going to be released. And then I suppose the growth in the IP and the potential that it had essentially being released there. I would say that we have stronger conviction with it. Fundamentals are very good. And with that, given that it is a similar price to what we paid for it, I would go and probably allocate maybe another 10,000 to it.
10,000. So we're at 17. Can we round it up a little bit? Just take it to 4. Just take it to 30.
Yeah, that'd be fine.
Just because we need to use this cash anyway. So in that case, we'll do 12,400. So interesting one on Games Workshop. This is one that my biggest holding I was going to leave out. You're pushing for it. We've covered it a few times on the show. I mean, I'm not going to go over it again and again because this is what anyone who does want to do these business in more detail can either research it or just go back and listen to the last episode we covered it. But this is a wonderful business. I do really like it. I think they've got, and that IP I think has so much potential. And even without the IP, I really, really like the business. I think just the models, I think you could do very, I think you could, I'd back the model. I think you could beat the market with it without the IP at all. I think it's that good a business. You've put this in the portfolio a year ago with us, and now you want to top it up, and you've just explained the reasons why and why you like it. Why don't you own it?
It's a very good question, Sam. I've been close a couple of times. I don't know. That may change soon.
Right, well, I'll leave that with you. I just thought I'd raise the point that you do seem to like it a lot. So that only leaves Disney. So we can either change the allocations, or is there anything else that you would want to suggest adding to?
I would probably just top up Disney a bit further, yeah.
The only issue is, so Disney, we've still got 30 grand. Oh, no, sorry. We've still got 22 grand. We've got 48 left to spend. I don't want to take this up to 70 grand because that's then 7%. And I do like Disney, but I think for me, sort of 4 or 5% would be my absolute upper limit.
Yeah.
So we do need something else.
Yeah, looking at what we hold.
So we could either do a new position or top something else up, or a combination.
If we were topping something else up, I probably would allocate a bit to Taylor Wimpey and Rightmove. But
I wouldn't mind that.
Yeah. I mean, I think it's definitely contrarian, and it may take some time to pan out, but I hold them. Well, I don't hold Taylor Wimpey, actually. I used to hold Taylor Wimpey. I've got Redrow, and I do have Rightmove. I'm very happy holding them for the long term. Yeah, I'd possibly divide it between those two. But that would be a fair bit, because they've got...
Well, let's see what they're worth now. So we've got 12 grand in Taylor Wimpey, 15 in Rightmove. I'll just see how the numbers work out. So we could do 10 in Rightmove, Taylor Wimpey, I don't know I think that's risky. So I probably wouldn't want to take that past sort of 20k.
I mean, it is risky. It's definitely risky.
No, I'll do 10 in each, see what that looks like. So that still leaves us with 28,000. That would take Disney up to a 5% position.
The other company that we've covered a few times on the show is DS Smith. And I know we both quite like that and think it's, certainly from a valuation point of view, it's very cheap. That could be an option.
I do like it, but to be honest, I'd rather have a higher Disney allocation than DS Smith.
Okay.
I know, I mean, to me, it's like, if we have Disney at 4% or 5%, would I rather have 4% Disney and 1% DS Smith, or just 5% Disney? At the current price, I'd probably have 5% Disney. But I do like DS Smith. Just have a look, see if there's anything else. Because if we could just get the Disney down a little bit, get it down to 4. There's nothing else in here that's screaming at me to top up. Unless you wanted to take something else higher. But I don't know, how would you feel about 5% Disney?
I think that'll be okay.
Right, okay. I'll get the share prices for Taylor Wimpey and Rightmove. But yeah, that's fine then. So in that case, I'll just get the... Okay, so the way this will come out then is we'd have 20 grand at Supreme, in Supreme, 20 grand, and that'll be a new position. 20 grand in PayPal, that'll be a new position. Both these would be about 2%. Another 10 grand in Taylor Wimpey, that would take that up to about 22 grand. So about what we originally put in, but that would take that back up to a 2% position. 10 grand in Rightmove, that would take that up to 26 grand almost. So that would be a 2.5% position. 20 grand in Grammar, that would be a new position, so 2%. Another 15 in Airtel Africa, that would take that up to a 4% position, and that would be worth about 40 grand. Another 12,400 in Games Workshop, that would take that up to about a 3% position. And another 28 grand in Disney, which would take that up to a 5% position, and we'd have 50 grand in that. I'm pretty happy with that. If you are. And that leaves zero cash again, on the basis we won't get a chance to invest it until next year.
No, I would go with that.
Right, so that is what we're changing. Overall performance, just to summarise, up 4.73% over 2 years compared to 9.74% for the world index. And in the last 12 months, we're down 6.5% compared to 7% for the world index. So we beat that by 0.5%. John, any closing thoughts or comments?
It's very difficult to beat the market.
I would add as well, I think it does show how important allocations are. Some of these calls we've made have been horrific. And what saved us has been the fact that we've not allocated a lot to it. I appreciate it works the other way as well, but we said it when we constructed the original one. 40% of this portfolio is in individual stocks. If we get those stock picks right, we can beat the market by quite a lot. We haven't got it right, but it's designed in a way where it protects the downside. So we've not underperformed the market by loads. I'm amazed by how close we've done to it, considering how poorly it feels like some of these stock picks have done. So I think there is something to be said for that. I think we've always talked about, I know you're much higher than me, but we've always talked about on the show having a proportion allocated to the index. For me, that's much lower than John. But I don't think either of us would ever say, I'm going to be 100% my own stock picks. Because when it goes wrong badly.
Yeah, exactly.
So, in that case, thank you very much for listening, everyone, and we'll see you all next week, but we'll do this again next year.
Thanks again.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.